The last secular gold bull was the 1970s, and why that matters now. Most investors misunderstand gold cycles because they confuse price appreciation with regime change. Gold can rise for many reasons. A secular gold bull only happens for one: loss of faith in the system's underlying truths. The last time that happened, unambiguously, was the 1970s. Not because inflation was high, but because the monetary framework itself broke. What followed was not simply a bull market. It was a repricing of trust. That distinction matters because we are approaching another such moment now. Secular versus cyclical. Why definitions matter. A cyclical bull is an expression of the system. A secular bull is a challenge to it. Gold rises cyclically when inflation expectations increase. The dollar weakens temporarily. Risk assets wobble. Gold rises secularly when the rules of money change. Confidence in institutions fractures. Previously settled economic truths are invalidated. The 1970s meet this standard perfectly. The 1970s, when the system admitted it was broken. The catalyst, 1971. When the U.S. closed the gold window, it wasn't a policy tweak, it was an admission. The system can no longer support its own promises. Gold transitioned from a suppressed monetary anchor to a free-floating barometer of trust. That single act forced the world to discover what gold was actually worth in a fiat system. The conditions: persistent negative real rates, fiscal dominance from war and social spending, oil shocks exposing resource dependency, central banks visibly behind the curve, public confidence eroding. Gold didn't rise because investors were clever. It rose because the system was relearning its own price signals. The resolution. The secular bull ended only when Volcker restored positive real rates and credibility to monetary policy. Trust was rebuilt, not cheaply, not painlessly, but definitively. That is how secular cycles end. President Richard Nixon, Price Controls and Ending the Gold Standard, NJCSS Journal caption. Why 2000 to 2011 was not the same. The gold rally from 2000 to 2011 is often labeled secular, but structurally it was not. Yes, gold went from approximately $250 to approximately $1,900. No, the system did not reset. There was no monetary anchor removed, no fundamental repricing of money, no restoration moment at the end. Instead, that period coincided with peak globalization. China's WTO accession. The expansion phase of the global credit supercycle. Gold rose as a pressure valve, not as a replacement. When liquidity rotated and confidence temporarily returned, gold stalled, not because the problem was solved, but because it was deferred. That distinction brings us to now. The pattern. Secular gold bulls follow the same trigger. There's a symmetry across history that is often missed. The 1970s. Bretton Woods fails. Gold reprices money. 2000s. Credit excess stresses system. Gold hedges fragility. 2020s. Fiat credibility, debt saturation, and geopolitical fragmentation converge. Each cycle begins the same way. A loss of faith in previously held market truths. What is different now is what comes next. President Richard Nixon, Price Controls and Ending the Gold Standard, NJCSS Journal. The emerging thesis, a return to hard collateral. The system is not moving backward to a gold standard. It is moving forward to a collateralized, monetary framework. Gold and Bitcoin as collateral, not currency. Gold and Bitcoin serve the same role. Scarce, non-sovereign, balance sheet honest. Gold anchors trust historically. Bitcoin anchors it digitally. They are not competitors. They are dual collateral layers. Ethereum as the settlement rail. Where past systems relied on paper promises and opaque clearing, this system runs on smart contracts, tokenized settlement, transparent, programmable rails. Ethereum is not money, it is infrastructure. Just as railroads did not replace goods, but moved them, Ethereum does not replace value. It settles it. Why AI industrialization forces hard money? AI changes the equation entirely. AI requires massive, continuous energy input, physical data centers, semiconductors, raw materials, skilled blue-collar labor at scale. This is not a digital-only revolution. It is a re-industrialization event. And industrial systems do not function on abstract monetary promises indefinitely. They require credible collateral, long-dated capital, and stable settlement. That is why energy, metals, infrastructure, labor are entering a structural supercycle. This mirrors the 1970s in cause, not form. Then oil and manufacturing exposed monetary weakness. Now, AI and compute expose monetary abstraction, same trigger, new surface. The blue-collar supercycle. No one is pricing. Every major monetary reset has a labor component. The coming cycle favors electricians, welders, construction trades, semiconductor technicians, energy workers. Not because of politics, but because physical systems are returning to center stage. You cannot AI your way out of thermodynamics. This is why inflation is no longer transitory in the classical sense. It is embedded in the rebuild. Below from ICT pre-FOMC Substack, FOMC Day, the liquidity pivot that ignites the next market, crypto, and labor regime. FOMC Day, the liquidity pivot that ignites the next market, crypto, and labor regime. From the market melt-up to the new labor regime. The coming market expansion does not create a jobless future. It creates a machine-levered labor renaissance with extreme sector dispersion. Wages will rise, but selectively. As the cost of money falls, debt gets refinanced. Margins expand from AI efficiency. Equity values rise. Treasury capital flows accelerate. Hiring velocity will increase. That produces real wage growth. Margin-driven hiring. Checkmark. Productivity-driven compensation. Not uniform wage growth. White collar does not collapse. It stratifies. What shrinks admin layers? Middle management. Credential-only desk jobs, redundant paper-pushing roles. What expands? AI engineers, automation specialists, data infrastructure operators, security engineers, on-chain financial engineers, systems architects. The labor market becomes barbelled. Elite technical operators at the top. Exploding blue-collar labor at the base. A shrinking credential middle. The death of the degree as an economic gate. Hiring now shifts to certification, proof of work, skill testing, immediate deployment. Already dominant in software, AI, cybersecurity, on-chain systems, automation. The economic result is unavoidable. The college-industrial complex enters structural decline. Advanced degrees remain for medicine, law, architecture, hard engineering, regulated sciences. Everything else shifts to market-verified skill. The blue-collar and vocational supercycle, the biggest winner. The largest employment and wage expansion of the next decade will occur in electricians, linemen, welders, plumbers, pipe fitters, HVAC, heavy machinery, crane operators, data center construction, semiconductor fabs, grid build-outs, logistics, housing construction, and renovation. These jobs are capital-intensive, location-specific, physically contextual, extremely difficult to automate. AI assisted, not AI replaced. At the exact moment AI explodes demand for compute, power, energy, infrastructure, manufacturing, housing, you get the largest blue-collar labor shortage in modern U.S. history, which drives wage bidding wars, overtime surges, union and non-union pay resets, trade school booms, paid apprenticeships, guaranteed regional job security. This is structural and decade-long. The AI productivity arrow margin arrow hiring flywheel. AI slashes unit labor costs, output per worker explodes, margins expand, capital reinvests, hiring accelerates, wages rise for high-signal labor, low-signal roles vanish, economic output resets permanently higher. This is nonlinear growth powered by machine leverage. Why labor data will look wrong the entire way up. Headline data will show white-collar layoffs, uneven participation, soft hiring optics. While beneath the surface, trade wages surge, infrastructure zones boom, data center corridors industrialize, energy labor shortages worsen. The economy will look confused on paper while actually being replatformed from the inside out. The system is changing, whether people are ready or not. Secular gold bulls are not about gold. They are about trust, collateral, credibility. The 1970s forced the world to relearn what money was worth. The coming cycle forces the world to relearn what money is. A hybrid system is emerging: hard collateral, gold plus Bitcoin, digital settlement, Ethereum rails, industrial throughput, AI plus energy, labor repricing, blue-collar resurgence. This is not speculative. It is structural. And just like the prior cycles, it begins with denial, moves through confusion, and ends with acceptance, after prices have already moved. This is only the beginning. The system is changing again for the same reason it always does. The old truths no longer work. And gold is once again telling you that before most people are ready to listen. ICT.